Okay guys, in this video I'm going to talk to you about the funding options that you have. So the funding options, you need money to fuel your business model to grow fast. Key points to remember. So the preferred one is really bootstrapping. So this is revenue. So try to sell your product as soon as possible. Then you have private equity or venture capital, where external investors are going to invest in your idea and give you money in exchange of a stake in your company, and in hope to making a return on investment on a 10x valuation, for example. So meaning giving $100,000 at the early stage and hoping to get out of it with a value of $1 million, for example. Banks can also lend you money. Often they will not necessarily do it in early stage. They may follow some private equity firms in some cases. You also can have a reward crowdfunding. Crowdfunding. Reward crowdfunding is basically telling your customers, hey, if you want to buy my product at cost, or at just very low, at a discount price, well, take the risk with me, give me the money so I can develop the product right now, and in a reward I'll give you the product at a discounted cost, or a gift, or whatever it is. So there's a reward, it's reward crowdfunding. You have donation crowdfunding that may work for not-for-profit sort of type of startups. There's debt, of course, loans, equipment leasing, that's available to you also. Always riskier, right? Because if it doesn't work out, you will still own the money in general. Organizations, so you can go after an organization that are there to give money away to projects that are helping solve needed solutions or needed problems, solve some of the existing problems, like the Bill Gates Foundation, the Chan Zuckerberg Foundation, and so on and so on. Government grants, so look out for government grants for the type of ideas you're working on. Network with your city mayor office. Try to figure out where the grants are coming from. Competition, where you pitch your idea amongst other ideas, like Mass Challenge here in Boston, and you can earn a check and so on. And then don't forget, at the end of the day, you're creating an economic entity, a startup, a business. So money is the fuel to your business. So who funds what and when? Let's talk about this for a minute. So key points to remember. So you typically start with a minimum viable product, right? So at that stage, one of the entrepreneurs I mentored actually taught me this this name here, what he calls the love money. So what is love money? So basically it's early stage angels or investors that are willing to give a bit of love money to help the entrepreneur, to show the love, if you will, and help the entrepreneur take the idea to a prototype, and in hope that other investors will follow, seeing one investor having made the move. Then one thing to know is, like the startups, as we mentioned throughout the course, is high risk, right? So venture capital, so venture comes from adventure. There's a component of risk in the name itself. So it's risk capital, venture capital, basically will fund startups. So they will go through what is rounds, the seed round, round A, round B, C, D, or round 1, 2, 3, 4, 5. So rounds. Why do they go through rounds? Well, they don't want to give you all the money right away. They're going to give it in rounds, so you can prove that you're going to do what you say you was going to do. So they're minimizing the risk by giving you envelopes of cash. So it's specialized in your industry. So typically your venture, don't go to any old venture capital firms. There are firms that specializes only in healthcare, only in technology, only in pharma. And so try to figure out who your competition or who companies in your sector are being funded by, and reach out to them. So you really want to go to a venture capital firm that knows the product you're in, and so that they can add value. the value that they will add is, adding competent people to your board, even in your team, advice, etc., etc. And then also, government grants for startups, and in France, for instance, it's a model where the seed funding or the early stage funding is really done by, initiated by government, and then, you have also investors. So then you have for the funding of established enterprises, think, the big firms, like Virgin or whatever. So here, the traditional investors here are more banks and regular funds, like 401k, retirement funds, and so on, and just, people, picking stock and investing in those companies. So it's typically less risky than a startup, but not always. Companies do go bankrupt, do experience issues. So it's really, always, expertise is needed when it comes to investing in companies. Then you can also get funded through an acquisition, right? You're going to start, your company is going to be absorbed and acquired by a company, and then you're going to benefit from their internal resources, their budget, their money. So you're going to be able to fund and execute your idea, but this time from inside a corporation. And so bottom line, there's a type of investor for each stage. So in this slide, we're going to talk about who are the investors. So who can invest in your idea? So in the US, there's some SEC requirements. So here are the rules. So 200K or 300K with the spouse of revenue per year. That's what an investor looks like in terms of revenue. And he should have earned that revenue for the last 2 years and in the current year. Or his net worth needs to be greater than 1 million, excluding the primary house. Or organization, it should be an organization with assets of over $5 million, with sophisticated individuals, meaning people that understand the world of startup, of venture capital, and so on. And the organization should not just be set up for the investment itself. Or any entity owned by accredited investors, aka rich people. So this is really the definition. So you can't really ask your friends to fund your startup, but this has changed in 2016 actually, with Mike Norman, who created WeFunder. It's an equity crowdfunding company, equity crowdfunding platform, which basically help people that don't satisfy the SEC requirements, to invest to a certain level in companies. The idea behind this is that why is it that only quote unquote rich people can invest in startups and make big return? So initially those requirements were set there, to protect the normal non-sophisticated people that don't really understand how it all works. But with the evolution and the rise of startups, it's been open to a broader audience and to sort of people that don't necessarily fit into the SEC requirements, but it's still highly regulated. So here we have examples of VC firms from the Silicon Valley. Legendary one, like KPCB, which is Kleiner Perkin Caulfield Byers, which is the name of the VCs, that have, that are partnering in this venture capital firm. Sequoia, Andreessen Horowitz, Greylock Partners, Koshla Ventures, Index Ventures, Founders Fund, which is Peter Thiel's, VC firm, Accel Partners, Google Venture, Lightspeed, etc. So they are masters in the startup game. If you look their website, you're going to see, that they've been the initiators and early investors of many companies that the brand today, like Facebook, Google, and so on and so on. Here are examples of VC firms in Boston. So General, Catalyst Partners, Highland Capital Partners, Atlas Ventures, Battery Venture, Third Rock Venture, which is more on, I believe, pharma and biotech. Same for Flagship Venture, Northbridge Venture Partners, Polaris, Bain Capital Ventures, Spark Capital, Charles River. So there's a lot of investors. I think according to the Crunchbase database, there's 1,200 plus listed investors in Crunchbase. So the key is to connect with them, be able to build trust with them, and pitch your idea properly. And then maybe you're gonna start working with investors, and and you're gonna build some great companies. So now, how do you find investors, right? So first of all, you need to target the investor you need, as we talked about. Then search them online, look at their website, look at their profile, look at the companies they invest in, look in databases such as Crunchbase, Angel.co, network in accelerators, or participate in competition where sometimes they go there or they participate there in panels, and network, and talk to them, ask for advice, be proactive. Go to conferences. Every year there's the VC firm conference of the year, in city, here and there. And then there's different types of connection, right? There's the warm connection where you know them, or someone that knows them that's going to introduce you, or the cold approaches. Cold approaches, they get a lot of emails, so they get contacted a lot of times by often inexperienced people also, so they don't necessarily respond to the first emails. So you need to really persist and show that you really want them specifically on your idea. Don't make them feel that you just shot them an email, taking a leap of chance, that you don't really value their company and time, and all you want is their check, because that's not going to work. So be perseverant, never give up until it works. And there's stats that says that not stats, the stories of entrepreneurs that said they contacted VCs for 200 times, or they got 200 no answers until they got a one yes. So what's the investor viewpoint? So here in this slide, I want to give you the perspective of how the investor sees you right now, right? You're coming with your pitch, you're all motivated, you have the greatest idea in the world. Well, guess what? They see you just as another Waldo, right? At first, because they don't know you, they don't know anything about your idea. So for them, you're just another of those guys, that comes in, thinks he has the great idea, and in some case they'll have the door open, listen to you, but at that point you're just another Waldo. So don't let your ego come in and be arrogant. Be there to show them, prove them with facts, with your knowledge that you gain preparing your pitch presentation, that you're not another Waldo, that actually you have the next big idea. But for that, you will need to know your stuff. Okay, pitch your idea in a crisp and easy manner. Simplify things. Remember when we looked at the Airbnb pitch presentation? Very easy, very simple. The best way to seduce an investor is to make it easy for him to understand, and that works with everyone. Customers, partners, employees that you're going to hire. Make it easy for them to understand. That's something that might sound easy, but actually is not, especially for engineers and software developers that maybe some of you are. You're very technical. You know a lot of the details, so you need to be able to boil things down to the essence, make things simple. So validate your market traction, okay? Show the proof. How many customers signed up? How many people are in the newsletter? How many pre-orders did you get? And so on and so on. Show that customers actually want that product. You're not the only one thinking that your product is great. Then show who is the executive team. Investors know that most of the startups fail because of the team, right? It's all people. A business at the end of the day is all people. So they will want to know, who are you thinking about for your team? Who are the CEO? What's the ego in the team? Are they difficult or easy to work with? What's the level of experience? Is it a cross-functional team, or is there duplicate skills and competencies? Are there any drama? So they're going to also look at unfair advantages, try to understand the risks. Did you mitigate, and are you mitigating the risks? How much risk is there in your company? They will want to know if you made accurate and realistic assumptions. right? So, if you say I'm going to make, $100 billion in 2 months, okay, that's maybe a bit far-fetched, and that's not going to fly. So you need to really come with well thought out, accurate and realistic assumptions in your budgets, in your funding asks, in your timeline, in the number of customers that you're going to attract and acquire, and so on. And then they're also going to look about at the legal setup, okay, and maybe discuss the exit strategy, meaning, okay, if we invest now, how are we exiting, what's the plan, blah blah blah. But the legal setup is going to be key, because the legal setup is basically going to talk about how you set it up, where did you set it up. And most investors, they like the Delaware Corp. Why? Because it's simple for them, they know well the law, it's fast, and they like Delaware Corp. So Delaware is a state in the US very friendly for venture capital investments. So bottom line, you need to know your business and be very flexible when you talk to an investor and you pitch to an investor, right? And it's the same when you work for a corporation. If you're going to pitch your idea to the CFO, he'll be looking that you're credible, your numbers, you can basically take that idea to reality. You are credible, right? So make sure you understand this very well, and you're going to be successful, because with the money, that's what you need, money to fuel your company. So make this a priority and become super good at it.